Hello and welcome to the latest news update on Canary News. Moody's Investors Service made the significant decision to downgrade New York Community Bancorp's credit rating to junk status, indicating a substantial deterioration in the bank's financial health and governance practices. This downgrade came as a shock to many investors, as the bank has historically maintained a relatively stable credit rating. The move by Moody's followed the bank's recent announcement of slashing dividends and increasing reserves, actions taken in response to mounting concerns over troubled loans tied to commercial real estate. The downgrade has had a profound impact on the bank's stock price, which has plummeted by approximately 60% since the announcement. Shareholders have been rattled by the suddenness of the downgrade and the implications it holds for the bank's future performance. Additionally, the departure of key executives overseeing risk and auditing has added to the unease among investors, raising questions about the bank's internal controls and risk management practices. Moody's underscored the importance of robust control functions within a bank, particularly in turbulent times. These functions serve as the second and third lines of defense against financial risks and are crucial for maintaining a bank's credit strength. The agency emphasized that control functions with a deep understanding of a bank's risks are essential for navigating challenging economic environments and preserving investor confidence. Despite the downgrade, New York Community Bancorp sought to reassure stakeholders by stating that it doesn't expect a significant impact on its contractual arrangements. The bank also highlighted its efforts to fortify its balance sheet and strengthen risk management processes during the fourth quarter. CEO Thomas Cangemi emphasized the bank's commitment to enhancing risk management by appointing experienced executives to key positions. Looking ahead, Moody's indicated that it would closely monitor several factors to assess the bank's creditworthiness, including the performance of its commercial real estate portfolio, earnings trajectory, and governance practices. The agency warned that further deterioration in these areas could lead to additional downgrades in the future, further exacerbating the bank's challenges. The downgrade has broader implications for the banking sector, as it has raised concerns about the exposure of regional banks to commercial real estate risks. The decline in New York Community Bancorp stock has also had a ripple effect, with other regional bank stocks experiencing significant pressure. Investors are closely watching developments in the sector, particularly as concerns about real estate exposure persist. In other tech news, Bitcoin miners are preparing for a significant event in April known as the Halving, where the rewards for verifying transactions on the blockchain network will be halved. This anticipated decline in revenue has prompted miners to start selling more of their Bitcoin holdings, as seen in the drop of miner reserves by 8,400 tokens since the beginning of 2024. The reduction in reserves suggests that miners are taking steps to strengthen their balance sheets and finance growth capital expenditure ahead of the halving, which will likely put pressure on profit margins. Analysts emphasize the importance of scale for miners in the post-halving environment. The halving occurs every 4 years and is essential for limiting the total supply of Bitcoin to 21 million tokens. It reduces the number of Bitcoin received by miners for their computational efforts, from 6.25 coins per block to 3.125 coins per block in the upcoming event. The selling pressure from miners has contributed to a decline in the price of Bitcoin, which has struggled since the approval of the first U.S. exchange-traded funds holding the digital asset. The movement of Bitcoin from miner wallets to exchanges has increased since the ETF approvals, indicating a trend of selling among miners to finance the purchase of more efficient mining equipment. Smaller mining operations, particularly those with limited access to capital markets, may face challenges due to the reduction in revenue post-halving. Larger firms like Marathon Digital Holdings Inc. have been utilizing cash reserves and raising funds through other means to strengthen their positions. Marathon, for example, has a substantial cash and Bitcoin balance, providing flexibility to navigate market fluctuations and potential consolidation opportunities in the industry. While Bitcoin experienced a significant rally in 2023, driven by factors such as the introduction of U.S. spot ETFs and the anticipation of the halving, its performance in 2024 has been less robust. The impending halving and its impact on miner profitability are factors contributing to the recent stagnation in Bitcoin's price. That is all the time we have for today. Tune in again tomorrow for the latest news update. Remember to like the video and subscribe to our channel. Thank you for tuning in.